This is Ken Long from Tortoise Capital with a review of the weekend trading report for September 14th, 2013. We have the market is in bullish normal conditions on an annual basis with weekly RSI 14. We're at 63 out of 100 in the middle range of neutral. On a 10-day basis, looking at the 10-day NDX, we're at 96 out of 100, so we're in overbought conditions. Looking at the market mosaic price with respect to the 200-day moving average is at plus 7.93% or yellow bullish. Slope of the 50-day moving average improved to 0.46, which is white bullish. ADX is basically neutral with respect to trendiness at 17.3. ATR percentage declined to 0.89% in the low end of normal. The risk index, which is the 30-period moving average of the VIX divided by the 10, has come back almost to the zero line at 0.97, which is still in risk-off conditions. The z-score of that reading of 0.97 compared to the last 5,000 days is minus 0.44. You can see the time series of that indicator and how the relative volatility is drying up, which is favorable for the long side and for swing trades in XIV. No change to the blended monthly rebalancing portfolios. In ETF2, the theoretical exposure is at 100%. The model portfolio will be at 100% exposed. There is a purchase this week in the model portfolio in symbol TAN, or the solar ETF. Most of the 13 and 20 and 32 ETFs in those two portfolios are on buy signals. You can see that the tops are U.S. tech, U.S. small caps, Japan, and Euro Asia. In the 13 and the 32, it's consumer discretionary, tech, healthcare, then the small caps. China remains pretty strong. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have been resistance points in the future. We need to see price clear 171 and hold for us really to believe that the bull is back and resuming, although you can see the last 10 days based on this 10-day regression channel have been very powerful up. The 30-day regression channel pointing slightly down, so that was, in retrospect, this is a nice buy on dip opportunity. And then the long-term regression channel, the 90 period indicated in the green, is also pointing up. Excuse me. The horizontal red lines are support levels that have held in the past. We get very strong support here at 163. The dark blue shaded area is the river. That's the 30 period Bollinger Band plus or minus 1. The light shaded blue area is the floodplain, which is the 30 period Bollinger Band plus or minus 2. You can see that price has moved from a point out of the floodplain on the south side to the far shore of the river. That is the classic or perfect Z swing trade. This was a very nice swing trade in XIV, although you see the price chart here reflected in SPY. Price is holding right on the far side of the river, which is also at the upside of the RAF regression channel. We'll see this week if it'll push through 171. You can see the slope of the 30 period regression line, which is this black line, has found support down here and is starting to resume northward. It's getting better. It has to get above this dashed line, this zero line, as you can see on the left index on that scale, for it to get back to positive, although it has flirted with disaster and recovered. You can see the 200 period moving average has crept back onto the chart, but we're starting to leave that behind now based on the price action of the last 10 days. Market is currently overbought. The jaws of PPO opened to the upside earlier this week around Monday and pointing the way upwards. So the test really is, can it hold here at 169.5 Can it fight its way through 171 and go beyond? If so, there's another 5 to 8% available on the upside. Excuse me. The nearest neighbor approach to this is this price action back here at the end of June, in which there was this 5 to 8% pullback, found support, came up, tested this previous swing high, and then broke through. Now it's pulled back, and now the same thing is coming up to test previous swing high. So let's see what we get. ETF regional report. Everything is on a buy signal now. EFA at 64 is better than the US at 62, so it's the power still shifted over to the global side, and that's based on strength in Europe, IEV, and Japan primarily. The emerging markets continue to lag. Inside the U.S., it's tech, small caps, large caps, mid caps. Small caps and tech are the two strongest sectors. Latin America and emerging markets are the two weakest sectors. Inside the U.S., you can see that the strength is in industrials, healthcare, and consumer discretionary. Utilities and staples are lagging. In the world market model, it's the growth side of the U.S. is exceptionally above average. Everything else in the U.S. is above average. Everything in Europe is strong. Japan and Asia, less Japan, are very strong. China, extremely so, along with South Korea. The emerging market side of Asia, suffering though. Thailand, Philippines, Indonesia, Vietnam. Inside the other asset classes, you see gold, silver, treasuries, and real estate. Exceptionally bad. Only oil and private equity remain strong. A virtual tie here between the global and the U.S. Business sectors. Australian dollar still lagging well behind. Inside the ETF top 30, we're looking for those that are green in the strength but white in consistency. That's ones that are should be doing well. GXC, the China S&P sector, is one of those. FXI, China MCHI, all these that are green in strength and white in consistency, extremely strong movers. Solar and biotech remain at the top, along with the clean energy. Lots of new additions to the top 30 here. Could be representing a shift in power to the China and European countries. See Netherlands, Spain, Italy, South Korea. So we're starting to see the outside the U.S. Narrative in force. Inside the Dow, and we'll be making the changes in the Dow here shortly once the three symbols are replaced. But for as it stands right now, United Health, United Tech, Boeing, DuPont, Bank of America are top 5. IBM and Hewlett-Packard at the bottom. Alcoa isn't long for the Dow 30, but it's moved off the bottom. And just reference charts for liquidity. Shifting to the daily report, a handful of 551W patterns, silver, gold, and blended commodities. And in the auto framer, these all test out better than 2 to 1. Cliff, natural resources, silver, gold, treasuries, and the VIX. A couple short signals here in Latin American emerging markets in the overreaction system. And you can see that the oscillation is almost complete here in the risk index, the Z risk Z. Bulls are now in charge on ADX, but there has not been a strong trend. So there's room for a 5 to 8% move if this bullish move of the last 10 days were to continue. No patterns to speak of in the Dow. Nothing on an RSI2 value. So this is a market that is fully priced, and it's either going to break out or fail from these price levels. but the top five in terms of max pain range compression: Microsoft, Hewlett Packard, Verizon, Pfizer, and AT&T. In the ETF 30, the only patterns we have are three 551Ws: gold, silver, and mixed commodities. Gold on a single digit RSI2, so that may be of interest for you. The VIX at 5 to 1, gold 4.5 to 1, silver and treasuries both a little over 3.5 to 1. Reference stats from the auto framer. Looking at the market mosaic, you can see how the volatility decline has started here as measured by ATR, and then also as measured by the percent value of the 30-day standard deviation. The slope of the regression line has been getting better, and you can see that it bottomed out here at 2 SDs below average, just where it's supposed to. And the last time it did that, it turned in a really nice move, which was this price movement here of about 8%, and that's why the upside is still there based on this last recovery. And the rest of the stats just for reference data. Notice we've come to the far side of the river now after rebounding from below the river. That's the Z swing right there. And in the Z scores of the regression lines, you can see the 10 has gotten fully valued. The 30 has found its little double bottom here at the bottom of the channel and still has room to go. The 90 slowed its rate of decay and is now potentially in a position where it can start supporting long term again. The last time that happened was back over in here when the market was at about 140, and you can see that kind of same location of all the regression lines. And that's everything from Tortoise Capital for the weekend. Should be an interesting trade week ahead. I think the long side is favored, but keep your risk measured and your powder dry.